4 on our books, Stan's cash account decreases by another $2,000. His office equipment account, an asset, is increased by $5,000 because he has $5,000 in office equipment. And
the Standard Deviants present The Eye-Popping World of Financial Accounting, Part 1.
And welcome to the eye-popping world of financial accounting, Part 1. Over the next 2 hours, we'll do our best to supplement and enhance your learning of the basics of accounting, including financial statements, double entry accounting, the general journal, and much, much more. As always, we're here to help you learn, but we're also here to keep you awake with our exciting minds and our downhill swivel chair races.
Don't forget, this is a video, so you can pause the tape, stop the tape, or rewind the tape at any time you like. If you need to see something again, just rewind the tape and watch us again.
Now it's disclaimer time. You must remember that this video is intended to supplement a basic accounting course. It's not a substitute for attending class. To truly learn accounting, you must attend your classes, read your books, do the homework, and listen to your professors. So, go to class.
Without further ado, I now present to you the eye-popping world of financial accounting, Part 1.
Part 1, the basics of accounting.
Section A, the accounting profession.
Let's start with the accountant, the heart and soul of accounting.
Today, class, I found an accountant to share with you. Can you say accountant?
Accountant!
Very good.
What's an accountant?
Well, a long-standing definition for accounting states that it's the art of recording, classifying, and summarizing in a significant manner, and in terms of money, events and transactions which are at least partly of a financial nature, and interpreting the results thereof.
Why don't accountants wear pants?
The accountant's job is to look at a business's transactions, decide how to record those transactions, and compile financial statements to report on the status of the business and the business's money.
Accountants work in many areas, primarily in public accounting and in industry, also known as accounting for businesses.
A public accountant provides services to businesses on things like tax advice and preparation, audits, and advising on management practices.
Another type of accountant is the accountant for industry. They do the books for a business. These accountants will be the focus of our discussion during this course.
Accountants for industry will understand the often ambiguous and confusing characteristics of the internal financial workings of a business.
Section B, accounting principles and guidelines.
Accountants classify financial transactions by putting the numbers into accounts. Accountants must classify a company's financial events for that company. If there weren't a set of guidelines for accountants to classify financial information and transactions, everyone would have their own different setups, and there would be no standard way to classify this huge amount of information, and complete chaos would ensue.
Accountants must work under a series of rules and guidelines that help them make basic decisions. These guidelines are known as Generally Accepted Accounting Principles, or GAAP.
GAAP is based on a number of accounting concepts and assumptions.
The business entity concept states that businesses are treated separately from other businesses and individual people. Businesses are separate entities from the owners for accounting purposes. Therefore, the assets and liabilities of the business are kept separate from the assets and liabilities of all others, including the owners and creditors of the business.
For example, let's say the owner's a big fan of remote-controlled trucks. She plays every day at lunchtime. The accountant will not count her trucks as company property, even though they're on company property, because they are an asset of the owner, so the bankers cannot use the toy trucks.
The cost principle states that the assets must be recorded in a company's accounts for the cost at which they were originally purchased, not at a perceived market value.
But there's nothing that says that I can't jack up my prices and rip you off. What time's karaoke start at the bar?
An example of the cost principle is our producer, Chris Mattingly. When we first hired him 6 weeks ago, his market value was 4 times what it is today. So even though the company may feel that he's actually worth much less than he cost on the books, we record the amount we originally paid for him.
We can earn revenue whenever we sell a pair of jeans to a customer. The matching principle states that we need to record all the expenses we incurred while selling these clothes, like my salary, in the same time period we record the sale.
GAAP has other principles, but we focused on 3 of the most important. So remember, the 3 principles we discussed are
1. The business entity concept. 2. The cost principle. And 3. The matching principle.
Now let's briefly discuss types of business organizations. Then we're going to talk about my briefs. They're very comfortable.
Section C, Business Organizations.
The 3 types of business organizations are the sole proprietorship, the partnership, and the corporation. Of course, we should mention that each type of organization has different advantages and disadvantages, especially when you consider taxes and liability.
We'll talk about the sole proprietorship first. A sole proprietorship is a business owned and controlled by a single individual.
The advantage of this formation is that the business is considered personal and is therefore taxed at personal income rates, as opposed to other more costly levels. There is no separate income tax on the sole proprietorship, which is a big advantage. The main disadvantage of the sole proprietorship is that legally, the owner is personally liable for all debts of the business. So although the business assets are separate from the owner's personal assets on the books, in the event that the business defaults on a loan or is sued by someone and loses, the owner's personal assets can be seized.
Thank you.
Hey!
Elroy, tell our friends at home what a second type of business is. It's a partnership.
Partnership.
That's right. You and I are partners.
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 Like, oh, because we have the tree farm.
Right. We have a tree farm, so we're partners.
Partners.
A partnership, though, is different than a sole proprietorship, because in a partnership, it can be owned by more than one person.
Like you and me.
Right, like you and me.
We're more than one.
Well, okay, as I was saying, in a partnership, each individual person acts as a sole agent in the partnership and is liable... And is liable, responsible for the debt incurred by the partnership.
Liable.
The third and final type of business organization is the corporation. The corporation is considered a separate legal entity from its owners and managers and frequently exists for the sole purpose of conducting business.
The major advantage to the corporation is that the owner's personal stuff is not liable to the legal claims against the corporation. The owners of the corporation are the shareholders, or those who purchase pieces of the business in the form of stock. Corporate income may be distributed periodically to the owners or the shareholders in the form of dividends.
The most a stockholder can lose is their original investment in the stock of the corporation. So a huge advantage of the corporation is no personal liability for the owners.
Mom?
Timmy, I'm your dad.
Oh, Dad. Jerry took 15 of my marbles because he said the corporation before went bankrupt, so he took them.
Well, if you and your brother formed a corporation, then he can't seize your personal properties.
Well, what if he doesn't give them back?
Oh, Timmy, you're just going to have to fight your own financial battles.
Wow, you're right, Mom. I mean, Dad?
Yeah.
A big succo disadvantage of a corporation is that corporate income is taxed twice. First, the business's revenue is taxed at the corporate rate, and then the owner's dividends are taxed at the personal income rate.
For the purpose of this video, in studying basic accounting mechanics, our focus will be on the sole proprietorship. Using the sole proprietorship will keep things clearer as we move along. Hey, what's with the mink oil?
Section D, Accounts.
Now we move on to the building block of accounting, the account.
When a transaction occurs, the accountant must accurately record it. The record or dollar amount is placed in an account. Accounts are grouped in what is often called the books.
The books are where the business's accounts or financial information is stored. Thanks! The standard definition of an account is a labeling of similar records for the purpose of classification and accumulation. So, the books are a place where similar transactions are grouped and recorded. Look, I've even got a book already.
Dollars spent on the same type of things are placed in the same account. The accountant must record business transactions and money for the business and records those transactions or funds in different accounts based on their types. Nickel? Thank you. The accountant creates accounts for the purpose of storing already classified information.
Oh, hey, how y'all doing? Now, you see how I keep all my tools together here? Well, accountants do the same thing. The accountant examines the transaction, figures out what type it is, then stores or places it in the appropriate accounts in the books.
Section E, the 5 account types.
Accounts themselves are classified under one of 5 main account types: assets, liabilities, owner's equity, revenues, and expenses. These are like super accounts because every individual account on the books must be classified as one of these account types. The first account classification is the asset account. Assets are something a business owns. An asset is used directly or indirectly in the production of revenue. The value of that asset is placed in an account labeled for that asset.
Some examples of asset accounts are cash, which is the account that represents the dollar amount of actual cash available or on hand; accounts receivable, which is the account that represents money owed to the company by its customers or clients; supplies on hand, which is the account that represents the dollar amount paid for supplies on hand; prepaid expenses, the account that represents money paid on future expenses like rent or utilities; office equipment, or the account that represents the price paid for office equipment; and building, the account that represents the price paid for the office building itself.
The second account classification is called a liability account. A liability is a claim on the assets of the business by an outside party for money or services. Liabilities are something we owe.
The best way to think of a liability is as a bill. The liability account is a dollar representation of that bill. Liabilities, or bills, may be secured or collateralized by the assets of the business. This means that if the business doesn't pay its bills, the creditors can sue the business and force the sale of enough of the business's assets to pay them back. Yipes!
Liability is not to be confused with liability, which first-time job seekers often employ in interview situations.
So, why do you think you'd be good for this job?
Well, for a while there, I was the Prime Minister of West Virginia. And after that, well, I did a little work for Napoleon. I was his personal hairdresser.
Very impressive.
And before that, I did a little bit of work for the Ottoman Empire. And before that, see, I was in Egypt, and they were going to put these big cubes up. And I went, nah, pyramids. Pyramids are the thing, you know? Yeah.
Some examples of liability accounts are accounts payable, the account that represents the dollar amount of bills owed to others, and mortgage payable, the account that represents the mortgage or a loan on a building which is secured by the building. In other words, if you don't make the payments on the liability or loan, you lose the asset.
The third and by far most confusing account classification is owner's equity. Owner's equity is the term which stands for the owner's investment in the business and the capital a business has accumulated. As the business earns revenues, the owner's capital or owner's equity increases. As the business incurs expenses or registers a net loss, the capital or owner's equity decreases. Also, as the owner invests more of his or her own cash, the owner's equity increases.
Assets are everything that I own. Yay! Liabilities are everything that I owe. Boo. Owner's equity is the difference, or what is available for me to enjoy.
Owner's equity tallies the dollar amount of any actual changes in the owner's stake in the company. So, all owner's equity accounts accumulate a change in the owner's capital in the business.
In a sole proprietorship, the primary owner's equity account is the owner's capital account. In a sole proprietorship like we are studying, there is only one owner, so he or she owns it all. But in a corporation, there are many owners, so owner's capital is a reflection of all of the owner's capital. We'll discuss the corporation more in Tape 2 of Basic Accounting.
Good evening. I'm Sunny Day.
Hello once again. I'm Storm Window. Once again, we've just received a report that owner's equity equals the owner's stake in the assets, and that owner's equity tallies the dollar amount of any actual changes in the owner's stake in the company.
Remember that, everyone. After all, you'll be held accountable.
I miss something?
Owner's equity also includes the effects of the revenue and expense accounts. However, expenses are first subtracted from revenue to find the net income for the company. This net income total then affects owner's equity depending upon whether its total is positive or negative.
The revenue account totals the increase in a business's assets from the sale of its goods and services. Essentially, this account calculates the success of the company, so it reflects the success of the owners as well. I, as you can see, am very successful. This cigar was handmade in sweatshops in the Dominican Republic. You know what I'm saying, baby?
Expense accounts tabulate the drain on a company's finances for goods and services used. As a company's finances are drained, the owner's equity is lowered too. The dollar amount of all expenses, regardless of which particular type, are calculated here.
We know that these are difficult concepts, but they will become clearer as we move forward.
Section F, Financial Statements.
The end results of the accountant's work are financial statements. A financial statement is simply a piece of paper or computer screen containing some type of financial information. Accountants accumulate all of the data from the different accounts and place this data in financial statements so inquiring minds can analyze the financial condition of the business.
I want to know. Good financial statements are absolutely essential to companies because they can help to evaluate the health of a business.
The most important financial statements are the income statement, the statement of changes in owner's equity, the balance sheet, and the statement of cash flows.
For the purposes of this tape, we will concentrate on these three financial statements: the income statement, the statement of changes in owner's equity, and the balance sheet.
The income statement looks at the profitability of the business for a specific period of time by subtracting expenses from revenues. This gives you the net income of the business.
So, the income statement lists a company's revenues and then deducts its expenses, which results in the net income of the business. Most businesses use monthly, quarterly, or yearly income statements. The statement of changes in owner's equity describes the changes in the owner's stake in the business, or the capital of the business over a specific period of time.
The first line of the statement is the owner's beginning equity, or the total capital or equity at the time the previous statement was prepared. Then the new investments made by the owner or owners into the business over the time period of the statement are added. The net income is then added because it is an increase in owner's equity. After this, any asset withdrawals the owner made for personal use are also deducted. The result is the owner's ending equity at the end of the period.
With these two statements completed, the balance sheet can now be constructed. This statement looks at the balances of all the asset, liability, and owner's equity accounts at a specific point in time, unlike the last two statements, which extend over a certain period of time, often a year. So once again, the balance sheet examines the balances of accounts at a concrete point in time. So, Mr. Former Prime Minister, is it? What would you say your weaknesses are?
Well, I'm really hard working, so I tend to just shoot up that corporate ladder like a rocket, right past the people who interviewed me. So pretty soon they're underneath me and I'm their boss. They get a little, they get a little jealous, a little envious, and they tend to be a little crazy about it, They kind of hate me.
On the left side of the balance sheet, all the asset accounts and their balances are listed. These balances are added together to provide the total assets amount at that concrete point in time. On the right side, the liabilities and owner's equity accounts and their amounts are listed. Then, these are added together to show the total liabilities and equity at that concrete point in time.
When a company acquires assets, they will often incur liabilities or expenses. So, for that reason, one side, the left, shows the resources or assets of the company, and the other side, the right, shows the sources of those resources, or the liabilities and owner's equity of the company.
Section G, the accounting equation.
The balance sheet format helps to illustrate how assets, liabilities, and owner's equity relate to each other.
The left side of the balance sheet, assets, must equal the right side of the balance sheet, liabilities plus capital. That's why it's called a balance sheet. The underlying assumption behind balance sheet is the accounting equation. Let's now discuss this new building block of accounting, the basic accounting equation. This is the fundamental overreaching concept in all accounting transactions.
The basic accounting equation states that total assets must always equal total liabilities plus owner's equity. Why is this?
The actual mechanics for the accounting process require that each side of the accounting equation equal or balance out to maintain accuracy.
Balance and accuracy are key.
After every transaction, the accounts must balance. Now, if this sounds like new information to you, well, it's not. Okay, go back, rewind the tape, buddy.
So, every entry requires another entry be made to balance the books. That keeps the accounting equation in balance. Now, don't forget, the second entry could be made to cause an increase on the right for liabilities or equity, or it could cause a decrease on the left.
As we've said, accountants must analyze financial events that affect a business. Another more correct term for a financial event is a business transaction. There are two different types of business transactions: internal transactions and external transactions.
Internal transactions are financial events that take place within the business. These include adjusting entries and closing entries, all of which we will explain later. In internal transactions, outside parties are not involved.
External transactions are financial events that take place between an outside party and the business, such as sales, payment for office supplies, and the purchase of buildings. We'll now show you several financial transactions and the accounting for them. Accounting is all about learning mechanics and techniques. The technique we'll demonstrate is the accounting equation, that the left side of assets must equal the right side of liabilities and equity.
Breaking news, the accounting equation of assets equal liabilities plus owner's equity always remains in balance. Does anybody have my itching powder?
Get the point here, people. The accounting equation must always balance.
Let's look at another business example.
Our business is called the Bathroom Network. It's owned by Stan.
Here at the Bathroom Network, we search the world over for the best in quality bathroom programming. You deserve access to your neighbors' private lives. You see, our network starts where the others stop. Join now and receive free of charge our Celebrity Bathroom Hour.
MCA. Oh yeah, baby. Oh my God, girlfriend, let me tell you about this.
Put down those supermarket magazines and pick up the true story behind your favorite stars.
It's so hard to put on lip liner with these lights.
Watch us before we watch you.
Now let's use the opening of Stan's new company to demonstrate the effects of transactions on the accounting equation. Remember, you can always stop and rewind the tape if you need to. This example will show you some of the principles we have already discussed, and more importantly,
the double nature of accounting. Don't forget, every time an entry is made in one account, an entry will be made in another account that keeps the accounting equation in balance.
Stan starts his company by investing $13,300 of his personal cash into his business by opening up a company checking account.
Therefore, on our books, the company's cash account, an asset increases by $13,300, and his capital account, an owner's equity account, increases by $13,300.
Then he purchases $100 in supplies, like the drills and ladders he uses to insert his cameras into people's houses.
On our books, his cash account decreases by $100 because he paid out $100 in cash. But his supplies account, an asset, increases by $100 because he bought $100 worth of supplies. Thus, one asset account decreases while another increases on the same side of the equation, so the accounting equation still balances.
Disclaimer: the building account usually represents something that doesn't move.
Stan decides to buy a used truck with a satellite dish, which he can use as an office as well as a broadcast center. They cost $100,000. That's right, $100,000. Stan's a little new at this. For the sake of clarity, the truck and the satellite dish are represented by the building account.
The truck and satellite